Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I'll be your host for about the next 20 minutes here on Options Guide TV. We have a couple of trades that we need to review. Insignificant trades, I guess. Both Coke and McDonald's we put together ahead of earnings on Monday. With Coca-Cola, they're both down a bit, I guess. Coca-Cola, we're going to be going out to the February 20th expiration, and because of that, probably just stay the course in it. On McDonald's, the stock is down a little bit, and the butterfly held its own. So it's an interesting trade, I think, in McDonald's in that we saw them announce earnings this morning, and the company is just down a smidge at this point in time. And right now we're looking to potentially sell out of that trade. And then we're going to look at DraftKings. DraftKings is announcing on a Thursday, and that means that we can do the Friday butterfly if we would like in DraftKings. The Super Bowl was wonderful for all betting sites. I heard it was almost 20 times as much money that came in on the Super Bowl as it did last year. So just the prop bets and the, I guess, headways that they made on being able to just offer more ways for people to bet. That has brought in a lot of money into a lot of the sports betting places. So we're going to do a little something on DraftKings. Now the news is out there, so it's once again one of those things that they're probably going to have a strong earnings, but we'll have to decide if we want to get bullish or bearish. And in this instance, we got bullish on both Coke and on McDonald's. So let's start with the McDonald's trades. Good old MCD. Then let's run to the Tradier Pro software. One second. I'm showing the McDonald's screen this way. Let me grab the right screen. Sorry about that. So I did put the positions inside the paper trading portfolio, and this is where we have our positions right now. We did a lot of things on Monday. We had a very productive show on Monday. We rolled a couple of trades. We closed out of a few trades. FedEx we did wonderful on, but it got pegged. It got too deep in the money, and that's part of the problem of doing a show Monday, Wednesday, and Friday. We're not always doing the trades live, but here's the McDonald's trade. So with McDonald's, we see the stock is down 3/3 to 322 at this point in time. We see that our butterfly, which goes out until Friday, is trading right now for an 85-cent credit. When we put the trade on with McDonald's, the midpoint for the trade was around $1 at one point in time. But my official paper trade that I selected was $1.30. And so at that point in time, when we looked at the trade, McDonald's was trading at 324.39. We did the 330, 335, 337, and we could get out for 85 cents right now. So the catalyst is gone. The implied volatility has came in on the option contracts that we sold. So let's run over to the options grid. And here's our strikes, and here's our order that's all set up. And we can get this done now remember, we're flipping the script, right? We're selling this option contract, we're buying this option, and we're selling that one. The exact opposite. Bringing in a net credit right now, it's 81 cents. And because we set up this trade, I don't know, with higher implied volatility, net volatility has came off. Market didn't move too far away. We can actually get out of the trade. if you paid close to $1, which was where it was at during the show, that was fine. 130 is what I had in my limit box, so we were looking to pay as much as 130, somewhere between $1 and 130, and right now it's trading at 80 cents. So we have it inside the paper trading account. So I'm going to sell it. I'm just going to close out of this trade, and once again, I'm not going to be able to get that 80 cents. I would expect to be able to get fairly close to that. I'd probably come in at a net credit. Well, it just moved. I'd say a net credit of 80 cents at that point in time, but I'm going to put in 60 here, and I'll take that 60 inside our paper trading app. It's at 74. I would probably keep it in at 80. Just let it sit in 80. The bid-ask spreads moved a little bit, and the midpoint came down to 74. I'd probably let it sit at 80 and try to close it. And if it didn't, I'd give up 5 cents. I'd give it 15 minutes, and if the order doesn't fill, I would move it another nickel. So here we are, selling to close the McDonald's short open wing butterfly. Well, let me do this first of all. No, yeah, I think so. Let's go and send that to the what if calculator. It's going to be upside down. It's going to be inverted. But now let's send it to the floor. Okay, so this is, once again, flipping the script, but this is what our trade was. We wanted the underlying stock to go up above and beyond this level. It didn't. It went this direction. If we, I guess, had sold the butterfly, this is actually inside the options playbook. I call this an inverse ratio spread. So there is actually this trade that's in it, the opposite of the open wing butterfly. But in here, if we did the trade, we wanted the market to go this way. The market went that way. Market stayed mainly probably more so because the stock is a $300 stock, that it's a fairly expensive stock that adds a lot of premium to the option contract. So the premium's holding. And this is a benefit of the fact that they announced on Wednesday, when the market actually closes on so then you got all day Wednesday, all day Thursday, all day Friday after their earnings report. Implied volatility comes in after their announcement on Wednesday. But if this was a Friday trade, there wouldn't be anything left. If you did the trade, you would have got rewarded if you were correct very quickly, but you also would lose very quickly. So in this instance with McDonald's, them announcing on a Wednesday morning, I thought it turned out to be a real solid trade. And you learn more about option trades that go against you sometimes than ones that go with you. And it shows you how sticky prices can be on higher price stocks. All right. So now on Coke, we also have that inside our portfolio here. And here's the KO position. So Coke had a strong quarter they sold off a little bit after their earnings report. They basically said that their organics products weren't doing as well, but the quarter was strong. So we see, and we actually went out a little further. We didn't do a butterfly. We straddled where the market was at, and we did a long call spread. So now we see Coke today. Well, let's actually take a peek at the chart on Coke, just to give you a hint. We were down a little bit, and now we're bouncing back. So I'll zoom in here after a strong move to the upside. So with Coke, I think that's about where the stock was at when we put it on. So let me grab my screenshot here and see. But I would just stay the course. And I think going forward, Coca-Cola is a staple that you can own. So I don't mind being long this, and I actually wouldn't mind getting long a long spread. But yeah, the stock was, here's the sell-off all the way down, closed up at the end of the day, and now we're leaning all the way back to, we were right around, well, the high on Monday, we were around 78. And then this is Tuesday, the high got up to 79, and now we're almost back to where we were. Momentum building to the upside on Coke. So let's get rid of that. Keep that one up, and let's see what we paid for Coke. Coca-Cola filled at 196 and we're at 154. Okay, so 196 and 54. So we did a 4-point wide spread. I think it was around 185 when we initially looked at it. It on my screenshot shows 196 at the midpoint on the trade, 154. So we're down, let's call it 40 cents on the trade right now. But we have time in this trade. We're looking at the 20th. So I don't mind riding this into the momentum. We can actually, we're gonna let's buy to open, sell to open. Okay, and we'll send this to the what if calculator. So here is our long spread, and here's where the market is at. It's at 78. We bought the 77. The market was right in the middle here when we initially put on the trade. Now, the profit and loss graph is showing that as of today, we still got some time left. So the green line is our profit and loss graph. As expiration approaches, eventually it starts going towards the yellow line. So be aware that if we stay where we're at, we're going to lose some money because of time decay. It's going to come back down to this range and get down towards this level. Even if the underlying market doesn't move, all that we get is whatever the 77 strike call is trading for intrinsically. On the way up, the maximum we can make is at the 81 strike, and this would be the good news, is that as expiration approaches, this is where we're at right now, and the profit and loss graph is eventually going to morph into what it looks like at expiration. So pivotal point, trying to get up around the 79 level. That at least gets us to the break even. It would be if we paid $2, which we didn't. We paid a little less than that, but if we paid $2, that means we got to get to 79 to break even on our trade. And I feel pretty good about the momentum. Like I said, the reaction was a little bit to maybe the fact that we've had a strong move to the upside and just a little bit of poor guidance. The conference call was a little bit more negative about potential sales in their organic line and in the cold chrome, and all the numbers on the top and bottom line were strong. Growth was strong. That's where we're at. Okay. So any questions on that? If you have any questions, we always want to make this an interactive show on Options Guy TV. Please feel free to put them in the chat box, no matter what platform you're on, and I will try to address them. But Options Guy TV is available through the TradierX.com, throughout all the social media platforms. So however you're watching, and then obviously you can always just go to the Tradier Hub, hub.tradier.com, and log in and set up a profile, and you have access to all the great speakers that Tradier sponsors inside the hub. Okay, let's get to a new trade. Those two are kind of boring. Not much to say, but not horrible trades either. We learned a lot. The McDonald's trade, I liked that one a lot going into the trade, and still like it now, but we obviously lost some. I just like the fact that it kept some of its premium, and because of that, it allowed us to get out at less than a 50% loss. But I would get out of the trade. Once again, it's an earnings play, so I'm not going to hang around to see if it comes back. It may come back by this Friday, but the fact that it's a Friday trade and we don't have a little bit more time for the market to bounce back like we do on the Coke trade, I just soon get out of that trade right now. That simple. All right. DraftKings, $26 is where we're at. And we're heading into earnings. Earnings are on the Thursday after the close. So they would be on the 12th after the close. DraftKings, we're trading at 173 volatility here on the short term. we're looking at a $26 stock. Now, the stock's a little bit pricey, but anticipating that they're going to have a decent earnings report. And we're going to make it all about the earnings report. So once again, we're going to come in and look at the 26 strike call option here. And we're just going to look at doing another spread like we did in Coke. Now, part of the reason why is it's not a very expensive stock, but vols are up. I mean, we can look at a butterfly, but I kind of like the concept of just straddling the market here and going 3 points wide on the downside. And so it'll be a 6-point wide spread. We would expect to pay $3 for it. I guess we could go 2 points. We got to 24 strikes, so let's do 2 points. Let's make it $2. Don't want to risk too much on it. Obviously, you can risk as many as you want if you want to go on out and actually do more than one contract, but we'll keep the one contract trade fairly inexpensive. We're gonna literally straddle the market. We're right at 26, which makes this trade easy. We're gonna buy the 24. We're gonna sell the 27, 28, and sell that. And trading, look at leaning a little bit. This should be $2. The extrinsic value paying 86 and you're selling 64. Vol is 169. Yeah, you're paying up for vol here. Look at this. So here's the difference. This 24 strike option contract. So it looks like we have a lot of open interest. We got a lot of skew on the put side of things that is generating some open interest. So people are leaning to the bear side just from looking at the vol skew. And because of that, the call spread is fairly expensive. If you buy this 24 and you sell this 28, the implied volatility on the 28 is 171, and the implied volatility on the 24 is 219. So that's nothing to sneeze at. There's quite a big bit of skew that is probably being generated leaning to the downside on DraftKings heading into that earnings report. So that kind of makes me want to lean a little bit more bearish on DraftKings. So if we flip this and we did this with puts, the math is gonna work in our favor. I don't like the fact that you're paying. This should be $2. We're right at 26. We got very short term to expiration. If you straddle the stock, we should be buying as much intrinsic value as we're selling, but we're not. So we're paying 222 we'll call it 220 to make 180 because it's 4 points wide. So let's flip this and let's look at the bear side of things. So let's go buy. And the way that I would probably approach this, we're going to do a trade for, I think DraftKings, well, if we look at the chart, DraftKings is spending a lot of money. And because of that, they've been beaten up on the underlying stock. This may be an opportunity, but we're sitting right at this precipice right here. So let's go out more days and show you the amount of support right on the lower end of this trading range. So you see how many times we touch it. Yeah, let's see, add another. Let's go 1,500 days. Okay. Just to try to draw it out a little bit more. But this is the bottom, right? Right here we had kind of a gap up, real strong candle, and then a gap in there. But we came back and touched this noise right in here, touched it again. Now we've gone all the way back down and we're all the way back to that level. So this is going to be, and that's what I'm seeing. So this is going to be a catalyst that either we're going to get this earnings report and bounce off of this support line on the bottom, or I guess next move would be one step lower. And where are we going? All the way down. These are the highs here, going all the way back to the 23rd. And I do think it when the support kind of when you're going on a longer term basis and you look at how many times this line has touched and not been breached. We came down, tried to get to that level, didn't quite get there, got here right there, and now we're back again. Yeah. Interesting range. Yeah. All right. I'm going to let you decide on this one, but if I were to do a trade right now because of the leanings on the bear side of things, I think I'd rather be, I like that support level. Well, if I were to buy DraftKings, I would, at this point in time, with the stock sitting right on a support level, but you got all this volatility and let's look at open interest out of the money. Let's go out to the 30-day option contract. Take a peek at that. Not a ton. There's no unusual volume that it's showing. Got some open interest down around the 20s. And I'm just looking to see where all this volatility skew is coming from. 509. Okay, so going out to the February 9th, look at this contract, the 1750. There's 1,664 contracts. There's three. So this looks like a very active expiration on way out of the money options. And look at the skew and implied volatility. Like these option contracts are still trading 35 cents by zero on that trade. So easy to say a wide bid-ask spread. You're looking at the 14 puts. They're trading for $1 on the ask. Wow. No open interest though. Not anybody's buying them. So no, not that big of a deal. They can trade for $1. Nobody cares. All right. So, let's cheapen it up. Yeah. Let's see. $180. All right, let's look at this trade because of the skew. All right. I want to get a little creative here. Let's buy the 26, sell 2 of the 24s, and buy 1 of the 23s. Can we get that done for 54 cents? Pays $1, you would double. So this makes this trade look very interesting, and it's the fact that the volatility, you're buying a 172, you're selling a 175, and you're selling it twice. I'm talking about volatility, 173 vol, selling once 176. You got to buy 178. But we can get this done for close to 50 cents. That means that if we go below 23, if we send this to the what, we still make 50 cents. See what it grabs. 56 here. 44. So if we executed it at 56, which it's showing right here, and the market went down, we could still make 44. Maximum we can make here, if we sit right on that precipice of the butterfly, is 143. 144, we'll call it. And that's an inexpensive trade on that. And if we do it on the call side of things, it's not going to be as cheap. So let's look at it the call way. Buy the 26. Stop moving on me. Sell 2 of the 28s, 1, 2, and buy 1 of the 29s. 53 cents. So where's the market at? 2609. I don't I think this is the way that I would go. If I'm looking to do this trade and we're sitting right on that precipice, the expected move, by the way, which is fairly important, let's head back to the trading tab, is 137 and 132. We'll call it 130 and 130. So it's 260. We're talking about a 2-point move. So 260 puts it at about the 28.50 strike. This is going to be the official paper trade. I don't want to spend too much on it. We're really at an interesting point in the chart. So we're gonna get bullish. We're gonna buy the 26, sell 2 of the 28s, and buy 1 of the 29s. And we're going to pay 53 cents for it. I'm going to stick with my outlook here on the chart that it's time for the stock to bounce back. They've been spending a lot on advertising, but the news about the Super Bowl and the monies that are coming into the sports book are all good. We don't know how that's going to turn out in their report, but the stock's down today. I like that. Let's do it. Here's the official paper trade. So I'm going to send this. Let's send it off. Now, I would assume I can get this trade filled for 53, and you might look at it tomorrow. See if this holds today at the 26 level, and we don't go beyond it. That is also true, that if we go below, because you got all day tomorrow that you can set up the trade. They don't announce until after earnings. So you could see where the close was tonight, and I would probably suggest doing that. But I like just the setup of this trade, and I'm going to send it to the floor. We're going to have to pay a little bit more than you have to pay in the real markets normally. So I'll make sure it gets, let's put it at 60 right now, see if that fills, and see if not, I'll pay as much as 65 cents for it inside the paper trading app. But here we go. We are buying the 126 call, selling the 28, and buying the 29, and we're going to know it right away. So when we come back for our show on Friday, the announcement will be out, and we'll see where we're at with the DraftKings trade. 60 cents, and I'm sending it to the floor. So that means it's $60 per 1x2x1 open wing butterfly that we execute. Oh, it looks like we might have filled. Yep. So the trade went through. No, we're open. I'm sorry. Let's change this one up. 60. We didn't get that done for that. That's sad. Midpoint, it says 77. Why won't it give me 60? Let's go down. I guess we'll go down to 50. Let's just close it. And we're open on this trade. We'll let that ride. All right, we're at time. So here is the trade. I'll leave it up there for a little bit if you want to take a screen grab of it on DraftKings. We're going to get long the butterfly heading into earnings. Their earnings is tomorrow after the close. There's a strong volatility skew to the put side of things. So people are buying puts in it. And I should have actually pulled up the put call ratio. But the chart is at a stopping point, right? Strong support right at this level. But if we do break down, it could break down hard. But that's why we're going to limit it to our 50 cents. We're not going to go crazy with this trade. And we'll see what, after all the news about all the monies that are coming in during the Super Bowl. And we'll see where we end up with that. That's it for this edition of Options Guide TV. See you this Friday, 11 a.m. Eastern Time, inside the hub. Hope to see you in the hub.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.